Good evening, ladies and gentlemen. We are delighted to have both Nilesh Bhai and Neelkanth. I was one of the things that's unique about both of them that they belong to a rare breed of financial services professionals who are also public intellectuals. I think when I say rare, that universe comprises currently of just two people, and both of them are here. So, so thanks a lot for being with us. Um, what a time to be alive, Nilesh bhai. I'll start with you. Um, we've had, besides all the stuff that's happening economically, the last 3 years we've had um, three major conflicts breaking out: Russia, Ukraine, this whole Israel situation, and now lately India. And I'm not even currently referring to tariffs and everything else. So, do you think investing has just become more complicated, or is it the impact of media and social media that makes these issues a lot more close to us than it used to be, say, 20 or 30 years ago?
So, answer to that is calling a person at 4 o'clock in your PKC office. The guy won't realize whether you are his friend or his enemy. आप इस जन्म का बदला ले रहे हैं, अगले जन्म का बदला ले रहे हैं. In my view, investing is all about basics. But then people become greedy or fearful and forget the basic. If you stick to basic, there's no worry. But if you have to outperform market and everyone else, if you are in that race, then sometimes these events will take you for a ride.
Right. But do you think that some of these events have real market impact, or are they overrated in terms of their impact on markets?
See, most of us, Somnath bhai, fail to anticipate the resilience of the company. For example, when rupee was 25 or 30 to a dollar, and now it is 84 to a dollar, the margin of IT companies have remained the same. We fail to anticipate resilience of the buyer कि बस वो price cut लेगा. It works the other way around also. So by and large, we have seen that businesses don't get impacted by events as much as market tries to predict. And the real question is कि earnings 10 पैसा कम आती है और stock 10% गिरता है. It's all managing expectation, and which is where that greed and fear emotions overtake rationality. And it has happened in the past, it will happen in the future. And which is where, as a fund manager, we have to maintain balance. If we can go back to basics every time there is an event, hopefully we'll come better in the outcome.
Just a segue into the more macro part of the story. Nilesh bhai likes cricket. All of us are, most Indians, as we were discussing, are cricket fans. So Rohit and Virat have retired. It seems that the Indian economy is a bit tired. Would you agree?
That's a very, very poor attempt at rhyming. No. Actually, I would think of it the other way. So, in fact, just to add to what the question that you had asked Nilesh bhai, see, I think we have to keep two things in mind. One, the human brain is programmed to think that whatever is repeated most often is the most important, because that's how our neural networks are programmed. And therefore, if the headlines are about, say, the India-Pakistan war, and frankly we're all emotionally involved, we think it's very important. But unless there is a meaningful risk of it escalating such that in Mumbai we start seeing missiles and people don't stop going to work and there's meaningful impact, GDP won't be affected, earnings won't be affected. So it does not matter. Now, It's a very unpatriotic thing to say when the army men are fighting in the front, but reality is that just because something is being repeated very often does not mean it's very important. And the contrary applies as well. And so this is where maybe we'll discuss sometime later that the fact that the real effective exchange rate of the US dollar is at levels last seen in 1971 and 1985, from where it proceeded to fall by 30 to 40% over the next 3 to 8 years, is a very important information piece, which not most people are talking about. So, but it's very important in my view. But I think it's something to keep in mind. Now, on the retired and tired piece, I think our economy is anything but tired. In fact, two of the things that I've discovered in the last month or so of research, they've reinforced the value of fiscal discipline, of low leverage. So think about the US. We thought that because the US dollar is the reserve currency of the world, that they have the exorbitant privilege of having unlimited fiscal deficits, that they can spend what they want. But now what has happened is that if you keep doing that, your net international investment position goes for a toss. So they have had the reserve currency status and current account deficits for most of the last 80 years, especially the last 50 years since the gold peg was broken. But their NIIP as a percentage of GDP, the NIIP, just for those who don't know, is a net international investment position. So the US as a whole now owes $62 trillion to the world. They own $34 trillion of assets, global assets. So the gap is minus 28, which is minus 90% of GDP. This was only minus 20% of GDP in 2012. It is only after that, when they've just gone berserk with fiscal discipline, or indiscipline, that they have really killed themselves. The Chinese are in the same state. The federal debt as a percentage of GDP in the last 6 years has gone from 40% to 90% of GDP. Their fiscal deficit is 10% of GDP. The general government fiscal deficit is 10% of GDP. It is at the same level as it was in 2020. Now, the comparison I make is that if you want to get someone to run, this is the balance sheet view of economics. If you want someone to run a marathon, are you better off with someone who's had a nice long night's sleep, has had good pasta in the night, and is all charged up, or someone who's already run 2 marathons and is wanting to run the third one? So both the US and the Chinese economies look very tired to me. Their balance sheet view is very weak. In India, we have low financial leverage, meaning the non-financial firms have very low levels of debt. The government has told you it is going to bring debt to GDP central level down to 50% by 2029, 2030. The 10-year bond yields are continuing to fall. These medicines work over a medium term. They don't work very quickly. So last 2 years, we've come through the trauma, and there's no softer word for it, the trauma of intense fiscal consolidation. We've seen fiscal deficits fall by 80% or 80 basis points of GDP, which is like an 80 basis point drag on growth. The drag this year is 40 basis points, so we are slightly better off. So I would characterize it as exactly the opposite of what you're saying, that we are now like with fresh blood, a lot of enthusiasm. We need some demand catalysts. Hopefully the interest rate cuts that are now underway, the liquidity easing that is underway will boost credit demand. And in 3 to 4 months' time, some high-frequency indicators will start turning.
So Nilesh bhai, some of us, certainly 3 of us here, but also maybe not everybody, enough grey hair to remember the early 2000s, late 90s. Does the current scenario look a lot like 99, 2000, 2001 in terms of what Neelkanth mentioned? Very solid macros, low fiscal deficit, low current account, PC stable, but we have a demand issue. So does it remind you of that era?
So, see, India is such a large country, there will be always something similar to some other past.
But the real difference is the leadership.
When in this city a bad incidents happen, what was our response versus what it is today? The second thing is technology. How many of us believe that our defense forces will be able to reply like this? And on heart, most of us will be positively surprised by the demonstration of this kind of efficiency. The demand is subdued on the urban side. Rural side is doing reasonably well. And now there are 4 catalysts which can pull this demand up. One is 1 lakh crore tax cuts given, and it is effective every year. Second, as Neelkanth mentioned, interest rates are dumbing down by 0.5%. It will come down by another 0.5%. 1% interest rate reduction lowers your EMI burden. There is $1 trillion of personal, auto and housing which will benefit by what? Housing rate. Then there is potential diesel and petrol price that as globally crude has come down. And finally, there is 8th pay commission effective 2027, which will put money in the pockets of government employees. And there are lots of government employees. Put together, one portion of Indian economy which is not firing at all cylinder, at all power, should get supported over next 24-36 months. Rural anyway will get support from a good monsoon. Put together, bearing private investment which is on the subdued, my feeling is that government spending, despite consolidation, consumption both urban and rural, and trade more on services, less on goods, will continue to propel economy. The challenge is private investment when despite low leverage, entrepreneurs are not stepping up. The Tatas, Birlas, Ambanis, Adanis, Jindals, they are on front foot. It is that small and medium enterprises which is not stepping up.
So that brings me to a question that I have often wanted to ask, and since I have both of you, I'll ask question of both. Starting with you, since you mentioned here, there's been a significant change from the early 2000s to now, technology, leadership, etc. But if you look at longer term GDP or macro growth, and if you take 1991 as the pivot, and all of us can agree that's the pivot for India, now we kind of in a phased manner took up what used to be called the Hindu growth rate from a 3.5% handle to sort of a 6-ish% handle. And since 91, various types of governments have come, gone. We've seen various colors of political dispensations come in. But that handle has remained more or less the same. So is it a case of the fact that Professor Rajkrishna, for those who don't know, who coined this expression, had a point there that maybe, we have a cap to how much we can do. And this is the cap. Very non-volatile cap, which is a very good thing to have. But this is the cap. So 6% is.
So, Somnath, by 2 policies over there. One, if you bet on a betting pitch, scoring runs will be easier. If you bet on a bowling pitch against hostile attack, scoring runs will be difficult. Between 91 to 2014, we didn't outperform the world. World outperformed us. But 14 to 25, we had jumped from 10th to 4th largest spot. So, outperforming the world by 6 spots, undoubtedly we have done well. So please look at relative on which pitch we were betting to figure out whether the batsman is good or bad or ugly. The second thing, why did we move from low single digit growth to mid single digit growth? That happened for a variety of things, but one big thing was abolition of license permit Raj. There was a time when we penalized company by putting a cap on how much they can produce. No matter the customer will wait for 20 years for a landline, 10 years for scooter and motor car, and so on and so forth. If now we want to go from mid single digit to high single digit, we need to abolish Inspector Raj. Today, there are so many laws which are burdening entrepreneurs. None of us have spittoons at our home, but there is a law which requires spittoons in factory. None of us are forced by law to maintain health record of our parents who have raised us. But by law, I have to maintain health record of my factory canteen cook, otherwise I go behind bar for 3 years. There is a law which says that canteen wall has to be whitewashed. But what is the definition of white? I think Neelkanth is wearing white shirt and you are wearing black shirt. Now you prove in the court of law, till such time you will be behind the bar. You better apply to what I say, and you know how to make that agreement. So if we can abolish license permit Raj to move from low single digit to mid single digit, now is the time to abolish Inspector Raj to go from mid single digit to high single digit. Have we made a beginning? Undoubtedly yes, but we have a long distance to cover. The entrepreneurs of India are unable to compete because of.
Yeah, so to add to what Nilesh Bhai said and just give some quantitative flavor to it, the 6.5% growth of the early 2000s was very different from what we're seeing now. Because, and this is the framework which I've often used, I think sometimes with you as well, that you have labor input, capital input, total factor productivity. Labor input growth in those years was way stronger than it is today because the population was growing stronger and all of that. The total factor productivity growth was not that strong. And capital formation used to happen in a certain fashion. Capital is the most cyclical of these inputs. So we now have labor force adding about 1% to growth. But I think TFP growth is now starting to accelerate. So we've done better than the rest of the world. As Nilesh Bhai was saying, we've outperformed. And large part of that is the pace at which we can absorb change. And those things are happening for a variety of reasons. So we are seeing, deep changes in the bureaucracy. We are, the joint secretary of today is very different from the joint secretary of, say, 2005, 2010. They're much more market focused in their solutions. They realize the value of the private sector. Now, can this move faster? As Nilesh Bhai is saying, 100%. Right? So we are both quite frustrated with the slow pace of change that we are seeing. But I do think that with the technology evolution, the acceptance, the belief in the government that private sector is important, technology change is important, and the creation of the India stack, a lot of the things that we managed to do and we are building layers on top of it, I think is all very important. The third aspect, which I'm hoping that all of these free trade agreements will open up, is that we had stopped opening up on the trade front. So what we did was we signed a plethora of bilateral trade agreements in 2001-2. In most of them, the trade went adverse. So our deficits with those partners deteriorated. And therefore, there was a reluctance to open up on trade. That we don't know how to open up. When we open up, the partners take advantage of it. And as a result, in the last 10 years, at least till 2019-20, we did nothing. With the UK FTA, hopefully now the US FTA, hopefully EU FTA, up to 70% of our trade will be now effectively on FTA. And that, I think, is going to unlock significant amount of productivity growth. The channel through which trade openness affects the economy is through productivity. Everyone looks at end demand. I think is a mistake. Even today, China, which is the largest manufacturer the world has ever seen, has only $1 trillion of goods trade surplus. And very likely this year they'll have much lower. So I think there are significant drivers of productivity that are still ahead of us. Labor force growth is a given. We may actually see faster growth because we're getting more women into the workforce. And one additional point I would like to add to what Nilesh Bhai was saying on the capital side is that we ignore the real estate cycle, the housing cycle, as a very major driver of end demand. Because the way I see it, private sector capex is an outcome; it's not an input. Private sector will invest. See, look at steel. I mean, Tata Steel today said they're spending 15,000 crores this year. They're seeing demand. Cement companies are expanding. So companies that see demand are expanding. Siemens said that they saw some 45% growth in their orders in the March quarter. So people are starting to do it. But when the real estate construction cycle really takes off, and for that we need significant deregulation at a local government level, which is where there are bottlenecks. So if we can do some of these right things, I think getting and maintaining a 7% plus growth rate in real terms is quite doable.
One more linked question. You mentioned the FTAs that are coming in. Now, this whole China plus one has been going on now for 6-7 years. The CHIPS Act was during Biden. So the Americans have been wary and worried of this whole China dependence on supply chain, and they've been actively encouraging people to diversify. But over the last 5-6 years that this has been such a hot button issue, most of the benefit out of the plus one have accrued to a Vietnam, a Malaysia, Thailand, partly apparently even Bangladesh, and India has been a relatively smaller beneficiary of the diversification that has happened. What do you think is the pivot moment there for India that this will take off?
So let's look at the pivot moments sector by sector. Because remember that even the Chinese attacked it sector by sector. So where do we have a competitive advantage? Where is it that we are the default option for at least, you're part of the the last 5 were selected. Whether you make it to the top or not is then dependent on you. So we are part of the game in electronics. We're part of the game, or we should be part of the game in apparel, footwear, heavy chemicals, a few other. Toys is a very small segment. It makes a lot of headlines, but if you see, it's a very small part of actual value of exports. Electronics is the big daddy here. Now, what we have seen in the last 6 years, partly because of very serendipitous but very productive agreement we had with Apple, and Apple is now, as Apple management says, they created 35-40 companies in China with annual revenues over $1 billion. So what they want, it's like being a distributor for HUL or Maruti, that look, we'll give you the end demand, we'll give you the capital, or we'll help you with the capital or with our turnarounds, and you just run the shop well. Now they had those partners. Now they are wanting to build those partners here. So we had 1.5 lakh crores of exports last year. This year they're talking about $40-45 billion, so 3.5 lakh crores. They are starting to build local partners, and on the component side. So the value add, which is say 15% today, can become 25% in 2 years. So on electronics, I can see, and maybe I'm a bit biased because I'm part of the kind of the ecosystem which is supporting this and driving this, but I can see very strong reasons to be optimistic. On footwear, I think that is right up our alley. It is a job which is so manual. When you see a footwear factory, you'd wonder how is it different from a Muchi making shoes on the roadside. But it's very manual, very labor intensive. But what is encouraging to me is that 5 of the major global shoe manufacturers, not the brand owners, but the manufacturers, are setting up factories in Tamil Nadu. Now, how big they are, how fast they scale up, we'll see. So I'm hopeful that on footwear, we are starting to get there. We can do things much faster. I have solutions, but it's not the right platform. On the apparel side, I think we've really struggled. We should have done much better. I put the blame squarely on the industry associations. So the reason why the electronics thing worked very well was that the electronics association got together, put their self-interest aside, or maybe collectively defined a self-interest, which is very important. Private sector will work for self-interest, but having collective and then educating the government. This is what you do. I'm promising I'll do this, and then hitting those targets. The problem with apparel industry association is everything is about, oh, just give me subsidy, give me subsidy, give me subsidy. Oh, there is a 2,000 crore PLI for footwear or apparel. oh, let's put the minimum threshold at 20 crores. What are you going to do with that? So I think we have struggled in some of those sectors. In fact, I'm told that many of the Bangladeshi factories are owned by Indian entrepreneurs. So they just took advantage of the FTAs and the LDC status things that they had. So I think it is up to us to solve those problems. Are we seeing significant traction in all of these 4-5 things, like electronics, footwear, apparel, chemicals, auto comps, etc.? Definitely. I think there are many more buyers who are now making the rounds of India, and we are starting to make those things. And in fact, it's also about if Apple can work, then a lot of other people can work. The moment Tamil Nadu government and Karnataka government and UP government start to understand how Apple works, they will know how to work with the next guy as well. So it's a learning curve, but I think we are getting there. Would we have done it faster? Can we do it faster? 100%. Does it make my blood boil how slow we are doing it? Yes. But as a market observer, is it enough for us to grow at 6.5%, 7%? Yes.
Nilesh, one, we mentioned Virat and Rohit have both retired. I think both should have retired about 2 years ago. I don't know what you think, but finally they have. The problem is that we don't seem to have the next level. I mean, I was just thinking aloud. It seems that the options are Sarfaraz Khan. Good guy, Bombay kid, all the Khadus, Bombay culture, everything, but maybe not, doesn't set pulses racing the way, say, a Virat did when he came in. Similarly, just to segue into India since 91, the single biggest lever it had for a lot of the growth was this growth in IT services. It pulled in a whole bunch of tens of millions of people literally into reasonably high paying jobs, creating demand for everything, starting from mobile phones to houses. That drove, I would say, a very large part of the growth that we have seen in the last 30-35 years. It looks like that is plateauing out for various global as well as local reasons. What would you, from a pure investor's perspective, because that also led to tremendous wealth creation for investors. A lot of these companies, starting with Infosys, got listed. What do you think is the next big thing we have as a trend? Or is it that we don't have any and there are lots of small trends that we have to follow?
So, whether I'll be right or wrong, time will tell. But one long-term trend could be precision engineering. If we read transcripts of big 7 companies, they are talking about robotics. Every company, every country is focusing on robotics, humanoids. I don't think so. We have ability to build robots at this point of time. Maybe we'll be positively surprised like our defense equipments. But can we become supplier of choice for engineering parts in robotics? There's not much difference between an automobile part and a robot part. Both needs to be used for million types. Both needs to be precise. We have cutting edge in precision engineering for auto components. Toyota hitherto was producing engineered spare parts in their group company only. First time they went out and they selected a Bangalore-based engineering company for that spare part. That's precise BR. So, like the IT companies captured Y2K and then eventually built full-scale product, I believe precision engineering companies will venture out into robotics, into precision components, into electrical components, and we will see companies equivalent of Foxconn emerging in India. Is it something which we can take it for granted? Answer is no. Kisna padega. But this is where we have a engineering skill and we can go and capture. The similar trend could emerge in a slightly shorter time frame in capital sector. China has always gone for let's say, bulk chemical, and bulk from a scale point of view, not from a quality point of view. Whereas we have gone for niche chemicals, again niche from a scale point of view, because we really don't have those kind of large company. But with tariffs coming into play, can the world start moving their procurement to Indian companies? We have technology, we just need to go for scale. Some of the existing chemical companies are not investing sufficiently for scale. One of them has a succession issue. But new entrepreneurs will emerge. We met one small chemical company, and he got an inquiry which is like couple of times more his production capacity, not spare capacity, production capacity. Now, will he build that scale and deliver? Time will tell. But segment like chemicals, where we have expertise and not scale, and precision engineering, where we have expertise and time to build scale, those are the kind of sectors which can work well over a longer term trend.
Right. So basically, people will still need you, and hopefully, in derivation, us. Good. That's good. So two more questions before I ask some of our clients also to ask their question. I'm sure tons of them. One for you, Neelkanth. The first one. We've not had any Economist jokes, and I'll keep that aside for this. So tell me, India's financial markets architecture is universally acknowledged to be one of the best in the emerging markets world, and probably as a practitioner, I think it's at par with most developed markets as well. But the price of that is we have a set of policies, including regulatory, including financial market regulation, etc., that seem to be too constrictive for an emerging market. And just a segue into what you mentioned around interest rates falling. Now, a few years ago, India transitioned into inflation targeting. Probably one of the last countries to transition there, just as the first countries who went to inflation targeting were feeling a little fatigued by the whole thing. Was it a case of a bunch of economists quarreling all of us into a regime that kept interest rates too high for too long and slowed growth incrementally for the last? And is that a real risk to growth recovery going forward?
So that I think is a very specific question. Is definitely worth debating. Is 4% plus minus 2 the right band for us? So if you ask some of the the folks who set the architecture or who ran the economy from say late 80s to say 2010s or something, they'll say that the 8+6 model was much better, that you had slightly higher inflation and you aimed for higher growth, and that meant a bit of rupee depreciation and all that, but it was fine, the growth was happening. And that 4% is too constrictive at our stage of development. So I think that's a debate worth having. The committee that did that analysis had its own logic. They're very smart people. But again, most of these things are you kind of pluck something out of the hat. So revisiting that whenever the next targets are to be set is something that at least doing an analysis around it is something which is worth doing. Has that been overly restrictive on us? I disagree. In fact, we have made so many monetary policy errors last year which have nothing to do with interest rates, meaning not the repo rate. The fact that the base money injection was totally ignored, that an economy growing in double digits, the base money growth was 4% for a long time. And then you had the LDRs being capped, the fact that you had 5 lakh crores of currency intervention and that was not replenished because apparently some people in the RBI thought that being seen as buying Government of India bonds would somehow ruin their reputation and therefore will not buy. I think those are the reasons why the economy slowed down. So the question to ask also is that If you're growing at 9%, which was perhaps a bit exaggerated, I mean, with the one-off reasons, recovery from the pandemic, why did we slow down to 6.3, 6.4%? Because not just that the fiscal consolidation was happening, as I mentioned, but also that we had extraordinarily tight monetary conditions. Over and above the repo rate cut that Nilesh Bhai also mentioned, there is also the cost of liquidity. So just to not make it too technical, but the CDOIS spread, basically the the overnight rate that is expected for the next 1 year, it's a 12-month CD, it's called a 12-month OIS. And then there is a certificates of deposit, which is actual funding cost. The actual funding cost, the spread is about 40-50 basis points in normal time. In March 25, it was 160 basis points. So if you have a 100 basis point expansion, even the repo rate is the same, well, that's not surprising that in February the RBI cut rates, but in March the weighted average lending rate went up. Now we are seeing, with all this liquidity injection that is happening, that we are seeing the CDOIS spread come down. So in addition to the 50-100 basis points of repo rate cut, you may actually see 100 basis points of reduction. And so remember that the moment you re-anchor to a 5% inflation, you can't have your 10-year bond yields at 6%. So maybe this 7-8 year transition has brought us to a phase where the economy is now adjusted, cost of capital is coming down, we can start having more productive growth. So what happened in the past, hard to say, it can't be reversed anyway. Can we manage our liquidity better? Like, the liquidity management framework had no measure of what's happening to the CD rates. Now, my point was on the feedback, and the good thing about our regulators, and see, they may work slowly, but there are feedback mechanisms and they course correct. So the RBI had a meeting with people, treasuries, bank treasuries and economists. And so my point was that, look, it is, so while you monitor liquidity, it is very important that you don't just look at the weighted average call rate, which is the overnight rate, but what's really happening to 3-month and 12-month CD rates. And the moment you start tracking that, you start to see that, look, there's not enough money in the system. And that the theoretical construct that money supply is endogenous, that the economy will create the money that it needs, sounds very elegant, but maybe it is not 100% practical. And so you need to keep tracking it. And that's where I think there's a lot to learn from the US or the Chinese, that they're very pragmatic. You see the currency intervention. Remember that 2007, Chinese were running 10% of GDP current account surpluses. Imagine the amount of dollar intervention they were doing. Why didn't they see money supply blow up? Because they were jacking up CRR. So CRR in 2010 was 22%. And now as they're doing the reverse of that, they're bringing out the CRR. So you have to be very pragmatic about these things. I think we were not. So I wouldn't blame all of the slowdown on just the 4% target. Maybe there was an adjustment process which was a bit more prolonged than it needed to be. Should we revisit it? We should definitely analyze. But I think with the liquidity easing now, my expectation is that the economy should start pulling up.
So one question before we open it up for the audience, for you, Nilesh Bhai, you meet lots of companies, small, large, startups, so on and so forth. Do you think there is enough innovation going on in India, or is it that most of us are essentially picking up models from somewhere else and trying to scale it up on India's base? So, just as there is no Indian Palantir, there is no Indian DeepSeek. So, do you think that innovation is something that is lacking?
So, our story is glass half full, half empty. Millions of farmers of India can come together to create India's largest FMCG company, which has converted India from importer of milk to the largest producer of milk in the world. And people who run that cooperative society aren't paid like us. No, all of us I know the salary paid to the CEO of Amul. I mean, since they couldn't recruit people from IITs and IIMs there to set up IRMA. And yet, the largest global MNCs operating in India is unable to catch up with that. Now, have they not done innovation? Well, they created a model which was non-existent in any part of the world. And I still remember when I was young, we had gone to Anand Vallabh and it was in a hot summer time, there was no AC car. So गर्मी की season में जा खुले window वाली गाड़ी में, and we saw cows or buffaloes who were covered with blanket. And then we asked the driver कि क्या बेरहम लोग हैं, ऐसी गर्मी में blanket पहना आया? Then नहीं सर, वो गीला blanket है, so that the energy of cows and buffaloes will not be wasted in fighting heat. In fact, they'll be able to produce more milk. Now, that's the innovation at the grassroots. Our challenge is that we are unable to convert that innovation to logical level through ecosystem. My wife is a PhD from IIT Bombay. She worked under a professor called Dr. Merchant, and they created, her specialization is image processing. So she created a model whereby even by capturing partial image, I can compare it with full image to find out who that person is. So you put in a railway station, airport, market, you can figure out this is a lost child, this is terrorist, this is, so it's a person. And she had gone to Boston or Chicago, one of the place for presentation, along with her guide. And while she was presenting her output, she got the fierce resistance from someone in a true American manner, to the extent that she felt कि boss ये क्या कचरा कर रहा है. In the evening, the same person who was a 4-star general came to meet her and said, my apologies. You must have felt very bad when I was resisting you so much on your output. And, I'm unable to understand that with the hardware which you have used, how can you get this output? We have 2 generation ahead hardware, but we are unable to get the same out. So it's very difficult for me to believe a third world country researcher is coming and telling me that this is our output. But the way you defended, I realize your program makes far better. Now, ideally, that research should have been converted into something useful. What is my wife doing? She's volunteered in Isha Foundation. She's not the CEO of a startup. Where did she lost out? The product was good, but there's no ecosystem which can convert this innovation into a marketable product. There was a listed company in India, and I don't want to name it, which where she had gone, met, shown the product, but it never reached the commercial stage. Now, my wife can be unlucky. What about her entire batch? There was one colleague of hers who ensured that on the transmission towers you'll be able to pass data. So along with power, data will go. And we had electricity connection everywhere, but we had no 5G network in those days. It was a workable strategy, didn't move forward. There was another colleague who created fire resistance fabric. So you put a coat on a textile and it becomes fire resistant. No ticker. There was another colleague which, most of us have challenge of fitting. We go to ready-made garments, but to get the exact fitting, dressing like Rajesh Bhai is very difficult. So they created a model where you just walk in with your clothes on and cameras with some kind of rays not penetrating rays like X-ray because there is risk of radiation, but little less harmful, will be able to get your exact measurement and then feed it into computer, and boom, you get the garment which you want. And if those fabrics are not available, order goes at the central level and it comes out. Wouldn't we all like that kind of fitting? But did anyone took that thing? Now these are the few things I remember in the badge of my wife just 15 or 20 years back. I don't think so we are short of innovation. Where we are falling behind is ecosystem to support this innovation. I'll tell you something which is not available on Google research, but Professor Ashok Chuchepala of IIT Madras shared with us. There are 7 kids in up north Chandigarh University. They decided to make a rocket 8. 60 lakh रुपया raise किया, and they have created a prototype of rocket 8. सोमनाथ उसका फोटो देखो ना, तो एक गली में टूटा हुआ बिल्डिंग है, वहाँ पे बांस लगे हैं, और वहाँ पे प्रोटोटाइप engine है. This prototype engine produced thrust of 4,500 Newton. And to make a commercial rocket engine, you require thrust of 25,000 Newton. ये तो बच्चे इंजीनियरिंग पढ़ रहे हैं, उनको थोड़ी गाइडेंस मिल जाएगी, 60 लाख की जगह पे 60 करोड़ मिल जाएंगे, 25,000 न्यूटन वाला इंजन बना देंगे. In the cricketing parlance, we have many Lakshman Sivaram Krishna, but we don't have that coach which can make them Anil Ko. We have many Vinod Kamblis, but that Ramakant Achrekar is missing, who can make them Sachin Tendulkar.
So let me supplement that. So that was very eloquent. I think we have to keep in mind that even the US, when it was an emerging market, 1820s to 1880s or so, it was relying on basic research conducted by Europe to build its products. So while Edison built the light bulb, he used a lot of the fundamental research that happened in Europe. It is only after that that you start seeing, and it's only in the 1920s and 30s that you see the number of Nobel laureates from the US in basic sciences starting to go up. And it was the arsenal of democracy, basically the investments that went into research and development around the Second World War, that really set the US apart. Now, remember that the constraint that Nilesh Bhai talked about from the ecosystem perspective is a constraint of capital. Because see, this is risk capital. Research very often does not work. Now, and therefore, the capital that needs to go in has to go in with a lot of risk appetite. When you have low income per capita and low wealth per capita, it is very natural that you will not have enough risk capital, and therefore many ideas will die out. And so we have to have patience about this. We also have to differentiate between process innovation and product innovation. So we've done excellent work on process innovation. I think product innovation, we are starting to come to the table. So we have seen, like for example, the government now is talking about product nation. Part of a group where we are trying to build structures is that the government, and so this phrase is now being used by many ministries. It is, and so product nation means that we are focused on brand building, we are focused on technology building, there is strategic autonomy. I myself, though the fact that I'm part of some of groups where some of the drone manufacturers and all those are part of it, I myself was shocked, as Nilesh Bhai said, at how effective we were in integrating our own drones with the S-400s and all the other stuff we imported, the Israeli missiles and all that. So I think we can get there. We are getting there, but we have to have patience that this is a 20-30 year journey. And you cannot leapfrog. Can we have processes to accelerate that, get more capital in, more foreign partnerships in? I think we have to. That's the only way to leapfrog. And that's where one of the things on what will drive our growth, I think the development of the global capability centers is absolutely underappreciated. The amount of technology transfer that is happening through the GCCs to individuals. Remember that for every AI, there are a million NIs, and so as they get trained, I think the diffusion of those technologies is much faster. So I think we'll get there, as we have to sweat it out for 20, 30 years. But I can see the path ahead of us.
50-50, like the Indian biscuit brand. So we'll take a couple of questions from anyone in the audience who wants to ask a question of either of Nilesh Bhai or Neelkanth.
Really very inspiring. Nilesh Bhai, you talked about Inspector Raj. My question is, what is stopping us from getting rid of the Inspector Raj?
When one word answer will be vested interest. Today, you would have read news, some RTO in Bhopal had 700 crore cash. Why will they let go that Inspector Raj? It's not that people are not aware yet, they are not trying to remove it. But there are multiple things which come into play. One is vested interest, second is a judicial system which is overburdened. Many a times criminals get away, and then the regulator or the gatekeeper has to tighten regulation so that doesn't happen. It means it creates enormous burden on the honest people. Our legal system is such that let the crooks get away, but honest people must face the burden of regulation and compliance. The third thing is lack of consensus. So government came out with Jan Vishwas 1 bill, which wanted to remove all these unnecessary rules, regulations. But when they went into consultation, some people said, no, this is needed. Some people said this is not needed. And they couldn't decide what is needed, what is not needed. So there are multiple things which come into play. It is suffice to say that when there is a crisis, we can leapfrog for a solution. But when there is no crisis, we don't gather courage to leapfrog for solution. And we are growing in mid-single digit. We are the fastest growing major economy. We are doing well. So what is the pressure for us to change? अच्छा ही चल रहा है, क्यों बिगाड़ रहा है? But we are not realizing that our potential is to grow at double digit. If I improve ease of doing business at a faster pace than what I am doing, the growth will go to double digit. But we are happy with 5, 6, 7 and not aiming for 8, 9, 10.
So thanks for this, Neelkanth. You started out with the fact that dollar real effective exchange rate is at like an elevated level and probably might reverse from here. And when you juxtapose that with the fact, in terms of what Stephen Miran and some of the other advisors to Trump have been talking about, is there a case to be made for a serious shift in terms of de-dollarization or whatever nomenclature you want to give that? And if you subscribe to that, what are the implications from an Indian investor's perspective over the next few years?
Okay, so I would de-link the two issues. The de-dollarization is a much more complex problem, and I'll address that. What's the build-up to this? And so Stephen Miran, frankly, has backed off from his own paper. So people who met him in Washington, I mean, he's kind of like an early advisor to the government who moves in from the financial sector, and I can see both of us here have gone through the same experience. You say some things and people start attributing that, oh, this is why the government is doing what it is. In fact, at the spring meetings, apparently he told many people that, look, I was just a financial market guy. This paper was written just as a possible solution. I'm just an advisor, I'm not a decider. So he's backed off from that paper. But the reality still is that if you have any system like the US's US dollar based system, the supplier of the reserve currency needs to incur a current account deficit. Over a period of time, the current account deficits accumulate, and therefore the net international liability position, as I explained earlier, builds up to a certain level where there needs to be a readjustment. So there was the Triffin dilemma with the gold peg in 1971. So it becomes almost inevitable that after a while you have to have that adjustment. So why is this imminent? Because the costs of the net international liabilities are now showing up in the current account. So there's something called primary income, which as a country, you earn something on your international assets and you pay something on your international liability. So despite a negative international investment position, the US had a positive primary income. So they were earning more on their foreign assets than they were paying on their foreign liabilities. Because most foreigners owned US treasuries, which were very low yielding. The American corporations and investors and government owned much more productive assets. In the last 7-8 years, this has completely reversed. So in the last 3 years, in fact, their current account, the primary income has dropped by 1.5% points of GDP. So it is now becoming imminent that some serious devaluation of the dollar is needed. Now, will the markets do it? Remember that unlike 71 and 85, the last two times, like the Smithsonian Accord of 71 that followed the Nixon shock and the Plaza Accord of 85, you only had to convince the Japanese and the Europeans. And remember that at that time, because this was 25 years after, the 71 was 26 years after the Second World War, they had rebuilt Europe, they had rebuilt Japan, and so the Japanese couldn't say no. In 85, again, the US has armed bases in Germany and Japan, so they could convince them. Now, how do you convince the Chinese today to let their currency appreciate against the dollar? So it's going to be a hard-fought battle. So I'm not saying that it's inevitable, but there are enough market drivers for why the dollar must fall. De-dollarization is a much more difficult challenge because there is this concept of the euro dollar. The euro dollar, it's not a concept, it's actually a reality that, because there were so many dollars floating around in Europe after the Second World War, and many of them were actually held by the Soviet Union, the Americans were afraid that if they all, because it was still gold backed, that if they come and ask for the gold, they will run out of gold. So they deliberately created a euro dollar market, which is dollar outside the US. So you could, if you held dollars, you could lend it to someone, borrow from someone, and all of that. That has been an integral part of dollar being a reserve currency of the world because it is so easily available outside the US and there are very few restrictions. For another country to become that is going to be a nightmare. I mean, it's going to take a lot of effort. It was built periodically over 10 to 20, 50 years. So I don't think de-dollarization is going to be a very sudden development, but I do think that the dollar needs to fall and it's very likely to fall in value.
So one more question. Yeah, Mr.
Nilesh bhai, you talked about precision engineering and the spillover which can go into robotics, etc. Now, with the kind of demand building up for commercial planes, and Mr. Neelkanth talked about drones coming up, do you think those industries will grow in India? Because both Boeing as well as Airbus are flooded with orders, and I don't think they have the wherewithal to actually get it from their existing suppliers. All these precision parts and metal and non-metal.
Definitely, that is an opportunity. There's a company in Dharwad which is making rivets which are now going to, I think, Boeing or Airbus for their fitment. It's very difficult for me to believe someone in Dharwad could be making rivets which will be used by aeroplane company, but it's happening. Now, why did Dharwad was able to do it? Because it was an engineering hub. There are opportunities, but to get approved as a supplier to aeroplane manufacturer is a 5-year or a 10-year waiting period. Do we have patient capital which can make that kind of investment? Are there people who are capable of making quality drones? Answer is undoubtedly yes. But can we scale that up? Can we run a company with that kind of complexity on a larger scale? And this is where we are sometimes missing out on ecosystem. We need, in some sense, a anchor Maruti in every industry. We were making motor cars before Japanese started making motor cars. And as per one of the WhatsApp forward, I don't know how reliable it is, but apparently Toyota got their engine manufacturing technology from Hindustan Motors because we were making that Austin Rover's engine. But the challenge with Hindustan Motors was that the model which they were making pre-independence, they were making in the 80s also. And hence, when Maruti came, it was a breath of fresh air. It created tiered suppliers with focus on quality, gave them scale, created product which was more suitable for Indian needs. And over a period of time, along with Maruti, we have seen creation of Motherson Sumi, which now operates 200 plants all over the world. One Apple and one Samsung will also created many electronic component manufacturers, mobile parts manufacturers, and eventually someone will create the Samsung or Apple equivalent in India on its own. So if we can get this anchor manufacturers in different industry and create tiered suppliers to them, tier 7 gives to tier 6, 6 gives to 5, 5 gives to 4, 4 gives to 3, 3 gives to 2, 2 gives to 1, and 1 assembles and sends it out. I think that path will create suppliers locally as well as globally. Will we get anchoring every industry? Answer is probably no. But with a large domestic market, we should be able to get in many segments.
One last question before we. Yes, sir.
From growth to innovation and everything set out in the capex cycles. What is your idea of this scenario? And secondly, how can we inspire to say double or triple the tax investors at the moment?
So let's think about capex in three parts. In any economy, it is analytically helpful to divide activity into households, private corporates, government. When we saw the investment to GDP ratio fall from 34% in 2012 to 27% in 2021, talking financial years, there was a 7% point of GDP decline that happened in investments. 5% points of that was household investment in real estate. 3.5% points of that was government and corporate investment in machinery. The other segments like intellectual property creation, household investment in machinery, government creation in structures, so all of those were still positives. They actually grew. The government was building national highways, railway capex was going up, but we saw declines in these two segments. What was the driver? Real estate cycle was 5% point of GDP. The value of dwelling construction fell from 16.6% of GDP in 2012 to 10.5% or 10.7% in 2021. There was a 6% point of GDP decline in the value of dwelling construction. If you think about the world around us and our daily lives, what are the things that we experience which are very goods intensive? It is dwellings, like these kind of dwellings, commercial dwellings and residential dwellings, automotive and urban infrastructure. Government capex as a percentage of GDP has been at about 7% unchanged. The state government did well, central government did badly. The last 5 years, the central government has picked up a bit. But that's still, the central government capex is 3.2% of GDP. It cannot be, driving it much further. So what we need now and what we are seeing is that the real estate cycle has turned, the power generation cycle has turned. So a very large part of the machinery drop was that it was in metals, in building materials, in construction equipment. All of these are inputs to real estate, commercial and residential real estate. And then there is the machinery that goes into power generation. So with the power generation cycle picking up, the real estate cycle picking up, this is the reason why that 27% has become 32%. Can that become 34? Can it take up to 36? I think we should try to do that. For that to happen, we have to relax controls in the real estate sector so that the real estate cycles are volume driven, not price driven. We have to improve investment in urban infrastructure. So the magic that we are seeing in Mumbai, the pace at which construction is happening, the magic that people in Hyderabad have seen, where infrastructure construction is incredibly fast. If we can replicate that over 500 cities, I think the investment to GDP ratio will go up. And the moment that happens, the demand for manufactured goods start going up. Because remember that most of the demand for manufactured goods, even in China, is for domestic production, domestic demand. So I think it's important to get these two cycles up. The rest of it, I think, will follow.
Right. So there were about 60, 70 other questions I had. And this is like the Sachin and Virendra Sehwag. Unfortunately, it's a 50-over format. So there is a limit. But thanks a lot, Nilesh bhai. Thanks a lot, Neelkanth, for coming today. And both of them will be around for a bit more time over dinner as well. So thanks a ton. Thank you.